In the dynamic realm of finance, few events have captured the public's imagination like the GameStop saga. In early 2021, the video game retailer's stock price went on a wild ride, skyrocketing more than 380% in a week, driven by a Reddit-fueled campaign to squeeze hedge funds that had sold the stock. But just as dramatically, it lost 81% of its value from its Thursday highs. This roller coaster movement wasn't just a simple market fluctuation. It was a battle between retail investors and Wall Street's titans, shining a spotlight on the often misunderstood world of short selling. This epic showdown was a David and Goliath story. The Davids were everyday retail investors congregating on platforms like Reddit's Wall Street Bets. They believed that GameStop, a company many short sellers had written off as a failing business, was actually undervalued. With a sense of community and a shared determination, they banded together to buy up GameStop shares, driving the price up and squeezing the Goliaths, the hedge funds with significant short positions. Hedge funds like Melvin Capital found themselves in a precarious position as they faced massive losses. By the end of January 2021, Melvin Capital had lost 53% of its total investments, a staggering blow that sent shockwaves through the financial world. But to truly understand the significance of this event, we need to delve into the history of short selling. Short selling has a long and storied past, dating back to 1609. After a power struggle within the Dutch East India Company, Isaac Lamar, a disgruntled former shareholder, hatched a plan to profit from the company's potential decline. He realized that the actions of French competitors would likely cause the company's share price to drop. Drawing inspiration from the concept of borrowing money, he came up with an innovative idea: borrowing stocks from a brokerage firm. He then sold these borrowed stocks to other market participants, planning to buy them back later at a lower price. This simple yet revolutionary act was the birth of short selling. It was a way to profit from a falling market, a concept that was both groundbreaking and controversial at the time. Over the years, short selling has evolved and taken on multiple roles in the financial ecosystem. One of its most crucial functions is that of a watchdog. Short sellers are often the first to spot overvalued or even fraudulent companies. In the world of finance, overvalued stocks are far more common than undervalued ones. The nature of the securities market is such that it sometimes inflates the prices of various assets to absurd levels. Short sellers, through their research and analysis, identify these overvalued stocks and take short positions. Their actions act as a corrective force, bringing stock prices back in line with their true value. Take the case of Enron, one of the most infamous corporate frauds in history. Jim Chanos, a well-known short seller, was among the first to see through Enron's complex web of deception. As he pored over Enron's financial documents, he noticed some odd offshore partnerships. These partnerships, where a senior executive of the company was the general partner and primarily did business with Enron, raised red flags. Chanos decided to take a short position on Enron stock. As the truth about Enron's fraudulent activities came to light, the stock price plummeted, and Chanos's bet paid off handsomely. His actions not only earned him a profit, but also exposed a major corporate scandal, protecting countless investors from further losses. Short selling also plays a vital role in risk management. In 1949, Alfred Winslow Jones, a journalist turned investor, made a groundbreaking discovery. He realized that by using short selling, he could create a market-neutral portfolio. In a traditional investment portfolio, the performance is heavily influenced by the overall direction of the market. But Jones's market-neutral portfolio aimed to eliminate this market-wide influence. He bought stocks while simultaneously short, selling an equal amount of other stocks. This way, the impact of market movements on the portfolio was neutralized. The value of the portfolio then depended solely on the manager's ability to pick the right stocks. Jones's innovation laid the foundation for the modern hedge fund industry, demonstrating how short selling could be used as an effective risk management tool. Another well-known short seller, George Soros, made headlines with his bold bet against the British pound in 1992, when the British government decided to raise interest rates to support the sterling. Soros saw an opportunity. He didn't just short the pound. He executed a complex and multifaceted strategy. He shorted about $7 billion worth of sterling, while simultaneously buying about $6 billion worth of Deutsche Mark and some French francs. He also bought $500 million worth of British stocks and German and French bonds, while shorting the equities of those countries. This carefully calculated move was highly leveraged, with a ratio of approximately 1 to 10. Soros's bet paid off spectacularly, earning him $1 billion. His actions, however, also made him a controversial figure, labeled as one of the most feared and hated currency speculators in the world. David Einhorn, yet another prominent short seller, founded Greenlight Capital at the age of 28. His fund achieved remarkable returns by shorting weak financial firms. In 2008, he was one of the few who recognized the underlying problems in Lehman Brothers. Einhorn confronted Lehman's management with the various discrepancies in their financial statements. When they were unable to provide satisfactory answers, he took a short position on Lehman's stock. As the financial crisis unfolded, Lehman Brothers collapsed, and Einhorn's short-selling strategy proved to be prescient. His actions were a wake-up call for the financial industry, highlighting the importance of due diligence and the dangers of overlooking financial irregularities. The GameStop incident, with all its drama and controversy, has reignited the debate about the role of short sellers in the financial market. Some view them as villains, preying on struggling companies and causing unnecessary market volatility. However, as we've seen from the examples above, short sellers can play a positive and crucial role. They are the anti-heroes of the financial market, driven by self-interest, like all market participants. Their actions, on the whole, contribute to a more efficient market. They help to expose overvalued stocks, provide valuable hedging opportunities, and ultimately enhance the stability of the financial system. In a free market system, which has proven to be a powerful engine of prosperity, participants should have the freedom to bet on both the upside and the downside of the market. Short selling is an essential part of this system. It provides a counterbalance to the often exuberant optimism in the market. The real enemies in the financial world are not short sellers or retail investors, but rather ignorance and wishful thinking. As long as the free market exists, there will always be cycles of boom and bust. Short sellers will continue to be an integral part of this dynamic landscape, playing their part in the ebb and flow of the financial markets.